You're watching Beyond Markets. Welcome, I'm Kenneth Igbomo, and on today's show, we'll explore how the capital increase of the African Development Bank will impact their work on the continent. And then we'll shift our focus to Dubai and find out how the Expo 2020 will impact the real estate sector in the country. Now join the conversation with the hashtag Beyond Markets and follow my handle at Kenneth Igbomo. Now, the Vice President for Finance and Chief Financial Officer of the African Development Bank, Swati Shabalala, says the 125% capital increase by its shareholders will empower the AfDB with a direct lending capacity of $100 billion in the next 10 years. She discussed this and more with me on the sidelines of the extraordinary shareholders meeting in Abidjan.
It's an extraordinary day because it's been in the works for the last 2 years. The discussion with our shareholders to increase, to provide more capital for us to be able to meet the objectives of the bank and the objectives of the continent. We are, as you know, Africa's development bank, and we see our fortunes as closely tied to those of the continent. So obviously this 125% increase in capital, allows us to lend over the next 10 years. And in fact, we did some calculations and some simulations, up to $100 billion over the next 10 years.
So that's how much
this is direct lending from us, which, and of course, doesn't take into account what we leverage with that lending.
All right. So yes, the president was mentioned that during the press conference, talking about synthetic securitization.
Exactly.
And I'd like to get a sense. Yes, you mentioned a little on how it's going to impact the lending growth, but
right.
How does it affect other ratios of the bank, so like your debt to usable capital?
Okay. So as you know, as we came to the end of our capital cycle, the capital that we got as part of the 6th general capital increase, we came up against the limits of ratios of some internal ratios, but more importantly the external ratios, which are important for maintaining our AAA rating. So as an example, the rating agencies, on a very frequent basis, they change their methodology. So on at least one ratio, we came up against that constraint. And in fact, our shareholders, particularly Canada and Sweden, provided us with temporary callable capital in order to be able to give ourselves and the shareholders time to be able to finalize the discussions on the capital increase. But it goes to show how tight the situation was, from a ratio point of view, that we needed this temporary capital from our shareholders to be able to tide us over until the new capital starts flowing from 2020.
All right, but with this, though, how does this impact your paid-in capital ratio?
Paid-in capital ratio.
Yeah.
So what it does, basically, it creates an enormous capacity in our balance sheet. So it's a significant improvement. I mean, I'll give you an example. One of the leverage ratios was close to the 100% limit. Drops to 40% as an example in the next 2 years. So it gives you a sense of how important this capital increase is.
All right, I understand from the last capital increase, the 6th one, the limits, it reaches limit somewhere around 2018. That's the prudential ratios.
Yes.
So, but this one now, how's that going to play out?
What we have done and negotiated with the shareholders is that we will, in fact, introduce, enhancements to our financial sustainability model, which enhancements would allow more frequent and automatic recalibration of our activities in order to be able to ensure and protect, these ratios for the full period of the capital increase, so that we don't have the situation where 2 years before the capital expected to run out, that it runs out. So I think this enhancement is welcomed because in fact it's looked on favorably by the rating agencies, who consider such strong risk management frameworks as being positive for the bank's rating.
Right, but the AAA rating, how is that going to be sustained going forward?
So in fact, by making sure that you meet all of the ratios in the first instance that the different rating agencies rate us on, but in addition to that, there are all these other intangibles that they look at. For instance, the quality of the management. They look at, we have our preferred creditor treatment is an important component of the rating that we have. Extraordinary shareholder support, and I think with this credit rating, with this capital increase, we've actually shown that we have fantastic shareholder support. These are all important considerations for credit rating agencies. But I think the most important thing is how you manage your capital, how you manage the risks that arise as a result of your operations, and the quality of the management that we have.
All right, then listening to the president during the press conference here, he was talking about the fact that the bank is not going to do more to reinforce its internal capacity. How's that going to play out?
So, I think this is part of the strategy that the bank embarked on in 2015, which was basically to increase the footprint of the bank on the continent, to ensure that we are as close as possible to our customers. So when he talks about reinforcing our internal capacity, it's really about our capacity to deliver to our client countries all over the region. So he is talking about making sure that we have the right investment managers, that we have the right risk management, operational risk management people, that we have the right oversight people, the right number, the right quality in all of these different the 5 regions of the bank, the 5 regional operations of the bank.
All right. He also mentioned about debt transparency for the countries as well. How are you going to keep monitor that in putting out your loans to the countries?
Well, this is in the context of our policy dialogues, the policy dialogues that we have with countries. Obviously, I think he made it very clear that the bank does not consider that African countries are in debt distress. However, there is a risk that if nothing is done, those countries may end up, or some of those countries may end up in debt distress. And part of it, of course, is that we can engage as much as we want with countries on a policy basis, but if we don't have full information, that engagement can end up not being fruitful. So I think he was really referring to how the bank intends to be more involved and engaged with our client countries on this particular issue. And obviously, I think this is a plea to say that we are only as effective as the information that we have in front of us.
All right, then still going back to how you're going to work with the private sector, still getting back to how you're going to play out with this the synthetic securitization, more or less moving risk to the private sector, or sharing some part of the risk with the private sector. What has been the experience so far, and what do you see changing going forward?
So I think, people, in fact, the question came up that, now that you have all of this new capital, why do you need, this sort of, risk operations, that take risk off of our balance sheet? Well, the fact of the matter is that we would like to do more with what we have. So where these operations are not merely to deal with situations where you've run out of capital, but in addition to that, they actually allow you to do more. So, the exposure exchange, for instance, reduced concentration of the bank in certain regions, which allowed us to do more in those regions. And in addition, the synthetic securitization that we did took some private sector operation risk to the private sector, who are very keen to have it, and which allows us to do more in the private sector. So I think these operations will remain a core part of the bank, and will continue to be a key focus, because I think given Africa's needs, that focus on doing more with what we have is crucial.
Yeah, because when you talk about Africa's development needs, it's like trying to hit a moving target, because as you try to get more capital, you're seeing more development needs are coming. I'd like to know how the type of financial planning tools you're putting in place to meet some of all this.
So, I think, a key part of our operations is saying that we the only AAA rated institution in Africa. That's important because it means that we actually have I don't want to use unfettered, but yeah, maybe perhaps access to capital markets. Okay, it allows us to help others to raise capital cheaply because we can provide them with guarantees as a AAA rated, guarantor, which allows them to generate, in the first instance, money that perhaps they would not be able to raise at all without our guarantee, but more importantly also, to bring on more people that would be, reluctant to bring investments into Africa. So, these operations are crucial in turning those billions to trillions that everybody talks about. That requires not only the actions of the African Development Bank alone, by the way. These are the actions of all of the MDBs and the IFIs. To say that how do we turn our balance sheets, into catalysts for mobilizing this international capital. And we've got at the Africa Investment Forum, which is coming up in the next couple of weeks, we will be introducing a guarantee product, which we are working on with the Islamic Development Bank and with ATI, which is intended, and we're talking to large American institutional investors to come onto the platform, which will help to actually de-risk projects, large transformational projects on the continent, and attract all of those trillions in institutional investor money.